In this episode of On the Tape, I welcome Keith McCullough, the founder of independent investment research and financial media company Hedgeye. We walk through Keith's journey from Yale hockey captain to institutional equity sales to hedge fund manager and the reason he started and has built Hedgeye to where it is today. Hedgeye marries the macro, the micro, technicals, and fundamentals into a suite of products that caters to all types of investors and advisors. We get Keith's take on the investing environment and thoughts leading into one of the most consequential Federal Reserve meetings of this investment cycle. And stick around for my Week 3 NFL picks as I have learned my lesson by picking the Jets. Today, I welcome a fellow Wall Street veteran and founder of Hedgeye, Keith McCullough, to the pod. Or Keith, do I call you Mucker?
It'll be a little weird if you didn't call me that, so thanks, Danny.
Exactly. Well, listen, I was reading some old Yale hockey articles from the late 90s, and I want to read some of these excerpts, okay? What McCullough does best is what isn't in the box score. That's one. Two, he is never afraid to block a shot or go hard to the net. But this is the one I think, this is your quote. I thrive on working hard and being intense on every shift and trying to be as consistent as I can be. And I feel like that's a great, entree into what you've built at Hedgeye. I think you would agree. And by the way, kudos for being the captain of the Yale hockey team at a time period where they were obviously one of the best in the country. So talk about kind of maybe your evolution from maybe even that moment, even prior to that, to kind of where we sit today so we can give people kind of the background on you.
Well, thanks for that. That's a blast from the past, but it's definitely, I guess for me, it'd be the most formative years of my life, right? Like as my adult life. And I guess some would still say I'm still trying to mature into an adult. And so is Hedgeye. But yeah, we like to get in fights once in a while or have historically, but that's just like, I think of it as just being part of the game. Back then, and now I never really was the best hockey player. I never was the smartest, person at Yale. I think I remind people I had the lowest SAT score at Yale, so I had that too. But I could, differentiate with, discipline and consistency. And that's really, if there's one thing that I can do, I know I can do that. And outworking people is a thing. And a lot of people on Wall Street, they like to say, well, what it really is, hard work. Well, for us, you can see it every day, provided that I'm working at the top of the risk management morning. It's 4:30 in the morning, somewhere between there and 4:45. That's when the game starts. So for us, it's a big project in showing people, Danny, like how the game is played from our perspective, letting you look inside of our locker room, seeing transparency, accountability, the kinds of things you'd see in a hockey locker room. There's a reason why everyone faces each other, right? There are four walls, and everyone has to come back after every period and be held to account. So I think that's a great opportunity for us and for our community and for us versus Wall Street. So we do like to make it, as I'm sure you've noticed, an us versus them type of a thing, kind of Mac versus PC. And that's okay. If I didn't have anybody to play against in the morning, I wouldn't know what to do.
So let's back up a little bit because our journeys were somewhat similar, although you captained Yale hockey team, and I think I was the captain of the intramural softball team for Pi Kappa Alpha at Emory, but we won't go into that. But let's talk about your equity sales like I was, and then you went to a few hedge funds. You were at Carlyle Blue Wave, I believe, towards the end of your buy-side days, and you wrote a book about it. But talk about that experience, because all these things, I think being on the sell side and the buy side kind of give you a great vantage point. And then I'm going to lead into why you started Hedgeye. Then we're going to get into the suite of products you're offering, and then certainly current thoughts on the market here. So.
Yeah, you and I were very fortunate. I think, with everything in life, it's timing. Like when did God give me an opportunity to play at Yale? Well, it turns out that I wasn't on a bad team. I was on a championship team. When did I get to go to Wall Street? In the late 1990s, when it was an absolute bubble, and I sat on what was called the equity sales desk. So I got to pick the phone, and it could have been anybody from Steve Cohen to pick your hedge fund that was calling in that day, and you had to answer it, right? I mean, like those were types of things that I would never be able to give, first of all, I'd never want to give back. And those are experiences, as you know, that help you understand, the flows of the game. Now, the flows of the game back then, block trading, bullying orders and different, trying to get IPO allocations, whatever was the, kind of the task of the day, very different than today, where the flows of an algorithmic machine are really driving things. And I think for me, that's a real important perspective, that experience and understanding where the game came from when you and I were born into it and where it's evolved to and where it's going. I think that those to use a hockey analogy that everybody would use, it's like, Gretzky's, most famous quote, you go to where the puck's going, right? And for me, the flows in particular have been, probably the most interesting part of the market in the last half decade or so in terms of how they've evolved and impacted markets.
Yeah, so being in cycles where the phone rings and someone says, how many shares did I get in an IPO in the late 90s versus 2001 and 2, when you're begging them to participate in deals, you get to see it all. So let's fast forward here then, post hedge fund days, you really wanted to create an independent research firm. You obviously saw what we saw at Front Point in terms of the macro of what was happening at the time. You were unable to execute like we were because you weren't in the right seat at the right time and they weren't listening to the stuff you were saying about what was happening in the great financial crisis, obviously. But you went and started Hedgeye, I think, right, like 2009, if I'm not mistaken, somewhere in that time period. And you built an incredible firm. And then I would say Hedgeye TV, I believe, started in 2014. And that was before people were using YouTube for any type of financial, type shows and stuff. So talk about what led you to that. And we're going to get into your product offering. Maybe you could talk about that now today, the stuff that you have in the Analyst, which you've obviously accumulated.
Yeah, I mean, it's like I said, it's timing. I was blessed with timing. I was blessed to be fired in 2007 for being wrong and being too bearish on the market in October of 2007, right? The stock market, of course, stopped going up for a while, starting in November of 2007. So again, that to me was a blessing. Why? Because I didn't know I was going to start Hedgeye, Danny. I still don't know what Hedgeye is ultimately going to be. I mean, every day, God willing, I wake up 2 feet on the floor and 2 hands on the keyboard and try to figure it out using the tools that I have. But again, I didn't time Twitter. I didn't time YouTube. I just used those tools because they were just like, going from a wooden to a non-wooden hockey stick. I mean, one obviously is better than the other. So, that was really, what happened was that gave me an opportunity because I could have easily gone back and started my own hedge fund again. I sold mine in 2006, ended up at Carlyle after that deal, went down. But I mean, I could have done that. I actually started. That's how Hedgeye started. It was called the MCM blog. You can kind of look it up if anybody wants to go back to the origins of the timestamp. Because I just showed everybody my book. I still do today, and today. I show my long only portfolio, my family's retirement account. So again, for me, it's always been about that, right? Like, what you see is what you get. You may not like it. You may hate it, whatever. You might actually like it. Who cares? These are the positions that I have. This is how I came up with these positions. And ultimately, Hedgeye, that's how I came up with that name when I finally decided that I wasn't going to run institutional, hedge fund money. I was going to try something different that didn't exist. Like if you could look inside of a hedge fund, what could you see? That's why I called it Hedgeye, right? Brilliant idea, right? I mean, just combine 2 very simple words. One, as I'm sure many would agree, is considered in some cases like a dark Sith Lord or something. What is a hedge fund? But again, let's put some transparency on that. Let's let people see what we actually do. What are the tools that we use? Right. So Hedgeye today, like what we provide is still always one and the same thing, which is these are the tools, Danny, that I use today to make decisions. I would never trade a market without a risk range, for example. So risk ranges. Yeah, I have risk ranges from everything from Google to gold that we publish every single day. So top of the range you sell, bottom of the range you buy. I know it's a unique concept in this kind of YOLO era for people that are half our age, but it's not an age thing. It's just what I do. Right. I mean, I don't chase. I don't buy high and sell low or, freak out low and chase higher. I mean, that's just not what I do. So everything that we do, including more sophisticated models, in terms of predicting or nowcasting things like inflation, right down to the decimal point. These are all things that I wouldn't be able to do without a team. Right. You can't run a massive hedge fund or one that is doing everything that a hedge fund would do. And they do pay us, to see what we're doing. Without a team. So I'm grateful for my teammates. When we publish things, whether they be lists of signal strength stocks, it's got my quantamental risk range and signal embedded in it, but it has to have a senior analyst on top of it with a model experience in the sector. It's not just some dude and some dudette running their mouths with a chart. I mean, it's a very different experience. And again, I think there's a big runway in terms of communicating and showing, more and more and more of what we do on a live switch.
So we got 4 lines in hockey. Let's talk about this quad process you have, quad 1, 2, 3, and 4, I believe, and that's how you kind of segregate names there. And I also want to talk to you about, you have these fundamental analysts, right, that are bringing you ideas. What do you do in the situation where the quad doesn't match up with the idea, whether it's a long or a short? Talk to me about kind of the quad and then what you do in that situation.
Yeah, thanks for that. I've never been asked that way about that, but there are 4 lines on a hockey team, and there are 4 quads.
I just want to keep the theme going, Keith. All right.
What you don't want to be like I was as a freshman is on the 4th line. All right, unless your team wins every game and that's your role. We were terrible my freshman year, and I was still on the 4th line every freaking game. So that's not good. Quad 4 is not good. So quad 4 is the one thing that we've never missed. Now there are 4 different quads in quad 1 and 2. The first and the second line are the good spots for U.S. growth, profit growth in particular in quad 2. Quad 3 is stagflation, and quad 4 is disinflation or deflation. We've seen both. We've called both. Now again, that's the number one thing that institutional clients pay us for. And then once an individual or family office figures out what we're talking about, because that's the one thing Wall Street never really gave anybody, right? Bogle gave you low fees. People give you this, they give you that. They give you newsletters where you're permanently long things, you're a gold bug or whatever. But they don't give you risk management, right? They don't get you out. And you definitely can't get out without my Canadian accent on that. So again, like you could always go back to the 4th line, but you can't get out of that spot once it's already happened. Like we had a stock market crash in 2025. It was between February and April, and we called quad 4 in February, and it ended in April. I mean, you didn't have to have a recession. You just had to have the rate of change of growth and inflation slowing and profits slowing at the same time. Every single time that's happened since I started the firm in 08, that has predicted either a major stock market decline, drawdown, or crash. So that's really the thing that we have, because any yo-yo can tell you what to buy, like buy stocks when you're in quad 1 or quad 2. Just watch CNBC. I mean, it's a certified clown show, right? I mean, anybody can pick a stock in a bull market. The question is like, how do you risk manage your way out of a bull market into a sideways market, a straight down market, et cetera, et cetera. So those 4 quads, to simplify the complex, I use my signaling process to front run the quads. The quads are the economic outlook, the environment that you're going to be in, and the signals are telling you when to time that. Because of course, just telling the market when it should go down, which legions of bears are dying every single day on that vine. This year since April, they're learning that lesson the hard way. The stock market's not crashing. We're not anymore, and we're not in a recession.
So where are we right now? Sorry. So if you're looking at the S&P 500, let's say the overall market, what quad are we in? And maybe this is a dumb question, but can you go from 3 back to 2, or once you're at 3, are you going to 4?
No, there are definitely no dumb questions about this. I think the dumbest thing you can do is tell the market what to do and or the economy, right? Like what it could or should do. And in this day and age, whether they're our age or half our age, people are hostage to their political biases, the feels, as I like to call them, on what the world is according to them, and therefore what it could or should be. Right now we have what we call quad count. So quad count is what are the next 3 quarters of the quads. Because I'm really bad when I get beyond a year in terms of an outlook. But once I get inside of like 3 quarters, 9 months, in that window of really a month to 9 months, that's where we have our highest batting averages and make not just our most contrarian calls, like make money when other people are losing theirs, but it's more or less, that's what is the quad count. So again, we're currently coming out of quad 3, which is a stagflationary quad where labor data has been the weakest of the growth slowing data, and re-entering what we call quad 2. So quad 2, we've seen fits and starts of that, where you get inflation up, growth back up. Like today's retail sales number was a clean cut quad 2. Like if you're a bear and you're expecting a recession, retail sales are up 5% year over year. I mean, that's double a good year in a former cycle. So, we're in quad 2 going, what we think in the first half of next year, Danny, is going to be a quad 1. So that's what I mean. Like quad 3, okay, there's enough slowing to get the Fed to cut. And this is what really this is what's made me so bullish, which is, I wouldn't say it's unnatural, but I'm generally not known as like a permabull for sure. I mean, when you have only growth getting better in rate of change terms, because 3 is less good than 2 and 2 is less good than 1, 1 is really Goldilocks. Because 1, you don't get Fed rate hikes, the economy continues to accelerate, and you get a broadening of the rally. So that's why we're long, like for the first time since 2021, which took a while. The Russell 2000, for example, or more broadening type equity positions into small, mid cap, single stock ideas and things of the like that work when you have that progression 3, 2, 1.
So what's your range then, if you were to give a range on the S&P? I know you do this daily, but where are you looking right now over kind of the next, towards the end of the year then?
It's like I don't do like the year-end target. I mean, I basically do a daily target, right? I mean, I can do an intermediate term target. I can get easily, north of six. I think it's 6,803, a number on the S&P like that. If I give myself 3 months, if I just give myself a day, I just get a new all-time high. So, for example, today, if I just like look at my notes, we're very specific about this. Like today, we're at 6644 on the S&P 500. Answering that question took me a while, right? Like all my bosses wanted to know, Keith, what's your price target? Where are we going? So I give them an answer because they were paying me,
Yeah.
But it didn't mean it was the right answer, right? I mean, the amount of times if they were to actually go back and look at what they paid me relative to how many times I had that answer wrong in that moment would be a very wide gap, right? Whereas where I actually decided to sell something and buy more of something was a totally different exercise, right? So my general position is here's my book today. We're positioned for all-time highs in gold, all-time highs in Qs, all-time highs in silver, all-time highs in what some people think are ridiculous ETFs, like something like UFO, for example, investing in space. Again, these are all longs until they're not. And the runway on the quads would say that, again, that those higher highs and higher lows, higher all-time highs, which last I checked, I always say is a long time, those should continue until they don't.
How do you reconcile, from a fundamental hat perspective, the dollar obviously coming down like it has an impact obviously on maybe the S&P 500 moving higher. It's the reason that gold and other commodities might be rising. So those signals that you're getting aren't necessarily healthy reasons that the market might be moving higher. But how do you think about that? Because the one thing that I think you would agree that has driven all of this, or the biggest concern, are rates themselves. And so if the 10-year yield were to spike higher for whatever reason, whether that failed auction, whatever, I'm just making stuff up that could happen out there. How do you adjust on the fly? And are any of your signals right now counterintuitive? Like, okay, I see that and I agree with it, but if that's true, then I'm concerned.
Well, they're like, whether or not they're healthy or not doesn't make or save me money, right? Like whether or not I'm positioned properly for it or not is what determines the answer to that question, right? So yeah, yes, it's unhealthy over the intermediate to long term for the dollar to make lower lows, for Bessent not to address the deficit at all, for you to continue to stay with the same old saw of begging for more cowbell from the Fed, down dollar, down interest rates. But that's been the trade that we've had on. Like that's not like luck, right? I mean, that's what quad 3 is. You have enough growth slowing data where the Fed can be bullied, in this case, politically, to go for 50 basis points potentially tomorrow on cuts instead of 25, to not raise rates, to replace the Fed head. All those things are unhealthy. I mean, it's like Scott Bessent today was poking fun at how long. I guess he was talking about that brouhaha you got into with Pulte, like he threatened to punch him in the face or whatever, which I thought was funny. But he's like, look, this has been going on since Alexander Hamilton, since people were dueling, with Treasury secretaries. Well, that's true. I mean, but the market's eventually going to have an epic duel with Scott Bessent and the administration if they don't address the deficit. Now, we have a process for that. When bond yields start to signal that they're done going down and the dollar starts to break out, then I will likely have a very different position. I mean, currently, if you look at gold, which has been like our most successful, major asset allocation, and it should be in quad 3, in every quad, we back tested everything that ticks. The number one asset class, major asset class and holding you should have is gold. Gold's its own currency according to us and the volatility of gold historically. That's quad 3. So is the best of gold going to end when bond yields stop going down and the dollar stops going straight down with it? It should be. I mean, there's a 95% inverse correlation between those two things. So, the key is to wait until the market signals that is done with, because it's so easy to be early saying that this is just bad, it's going to end in tears. I mean, we all know it's going to end in tears. It just so happens that there aren't that many people on Wall Street that end up timing the tiers properly, right? And that's my goal. And I want to be I don't like to lose. I want to be undefeated next time the stock market crashes again. So that would be a good thing, is to notice those things. And I don't know when I'm going to notice them.
I'm with you on the gold. Curious to get your thoughts on Bitcoin, and I can give you mine, but I'd love to get your thoughts on that. How you might have evolved, like I've tried to evolve over time here on this.
Well, I mean, to me, anything that's liquid that trades, I'll evolve alongside it. I mean, I'm short sugar and I'm long Ethereum. I mean, am I more bullish long term on the consumption of sugar than Ethereum? I don't know. I don't care. What I care about is the price, volume, and volatility attributes of whatever it is it ticks. And the longer that thing can exist, in time and space, the longer it proves itself. And that's what Bitcoin's done. Bitcoin, back testing against the quads, almost always crashes and certainly always draws down in quad 4. Okay. So we're not in quad 4. We were short Bitcoin from February to April. Now we're back on the long side of Bitcoin. The relative, or what you call the performance divergence between Ethereum and actually Solana, anything that we model, we have a whole digital assets research effort here. Like if you look at Solana, Avalanche, any of the signals that we publish on daily, they're just like ripping new highs, whereas Bitcoin is signaling lower highs. Some people think that that's like a canary in the coal mine because it's been often the canary in the coal mine. It has front run the NASDAQ weakness multiple times. In this case, I think that there's a dynamic setup here with Saylor having screwed so many people over with his narratives and changing, the goalposts while he sells stock into it. Because you got all these, Bitcoin treasury companies that are listed publicly now that are just like on the same Ponzi, right? They're all levering up to, using debt to lever up to buy the damn thing and saying that that's a stock. I think that like from our research perspective, that is highly divergent versus something like Solana, which is just getting its initial, kind of treasury buyers of the crypto. But we'll have to see. I mean, if I look back in this market if the world ends tomorrow, according to the people who have been saying it since May, maybe that'll be part of it. I mean, because that's definitely a signal that has been signaling, like I said, lower highs. When something's lower highs and goes to bearish trend on my signal, that's the get out signal. Currently, Bitcoin, yes, lower highs, less momentum than the NASDAQ or gold, but it's still signaling bullish trend.
I couldn't agree with you more on these treasury companies that are buying crypto that are levered. If you like the space, just buy, the underlying itself. So
why would you? But like you and I, it's not our first rodeo. I mean, but a noob or whatever they call themselves these days, they keep changing it. But why would you pay a premium to a guy named Saylor, when you could just go buy the damn ETF, even if you can't buy it on a Coinbase account? With no premium, it doesn't make any sense.
I agree. All right, so you cater to hedge funds, long onlys, retail, advisors. Basically, you run the gamut. I'm curious right now, from a sentiment perspective, what you're getting. You kind of alluded already that the institutions kind of aren't as long as you think they potentially could be. Although I've seen manager surveys that indicate they're now on the chase. Give me a sense of what you're getting back in terms of feedback from each of those cohorts.
I would say, the biggest pushback we had in the last month was us finally taking on a long position in the Russell 2000. That didn't seem to me, it's not only just what it was in terms of client feedback saying, this is a dog, there's the lack of profit growth, blah, blah. By the way, profitless tech is one of the best factor exposures you could be long right now. So profitless actually in quad 2, as perverse as that sounds, is one of the best places to be. So is high short interest. The Russell has a lot of those things. Our hedge fund clients definitely didn't unanimously agree with that call. Let's just start with that. You can look at CFTC futures and options positioning, which we do every single week, non-commercial, and you can see the biggest net short position coming into the last month, really the last two, was indeed the Russell 2000. And there's not an inconsequential net short position. Like I think it's 117,000 or thereabouts net short contracts in S&P index, E-minis, et cetera. So, this has been a wall of worry, man. Like you get this pushback and feedback all the time, especially from hedge funds that have to run neutral. Because it's really, really fucking hard to run neutral when the market's not neutral. That's why I don't run neutral. I'm not saying it's not a hard job. It's actually a way harder job. To me, that's like you're shrinking the strike zone, and I suck at baseball anyway. But you're really shrinking the strike zone, and you're making it a lot harder on people to perform. So I think some of that feedback is that it's just getting harder in an oversupplied industry, hedge funds, to generate alpha. And I don't know if that has anything to do with the cycle or anything. And then finally, you do get a lot of pushback from long onlys on market structure or the flows of the machine, because they keep looking at valuation. I don't start with valuation. I don't use valuation. We use valuation to augment our views. But the flows of the machine are highly misunderstood. The structure of the options market, the contribution of ODTs to daily flows. These things are like mostly where the long only community is kind of still exploring and trying to understand, versus what you and I would have done 20 years ago, which is had to look at anything like that at all.
Yeah, some of these large market neutral shops that you're talking about, they can't even afford to even look at names underneath, let's call it, 10 billion market cap, because they need liquidity and they need to get in and out over time. The thing about the Russell, and tell me if I'm wrong on this, it really is tied to one thing, which is rates. And when the 10-year yield moved from 4.5 to 4, effectively, shorts needed to start covering, because it is the one fundamental thing that impacts a lot of small companies, is the ability to finance themselves. So you would agree with that?
Yeah, that and profit growth. I mean, we were short the Russell from the end of 2021 to we didn't have a longer short position coming into this year, post being shorted into April. But so we went from no position to a long position instead of what we would routinely go to a short position. Why? To your point, rising interest rates, rising cost of capital, negative earnings depression. Like some people like to call recessions, we called a depression in Russell earnings. I mean, there was at one point year-over-year earnings at the bottom, 22 into 2023. Danny, were like minus 38% year-over-year earnings growth for the Russell. I mean, that is brutal, right? So now the Russell 2000, yes, bond yields, I agree, that's one factor. But another major factor, which again aids and abets the factor that you mentioned, is the rate of change of Russell earnings growth is now positive double digits with very easy comparisons. So, that's almost a perfect setup for me. Easy base effects in a former short that people are still stuck in for the former reasons that have since turned materially the other way. It's not to say that bond yields don't bounce and the dollar goes up, that everything stocks, never mind the Russell's not going to correct. But, from here on, I mean, into quad one, you'd stay along the Russell.
Russell working its way up the hockey line, so to speak. All right, so let's talk about the product that you offer. And so you have the macro show, which we see you on. You have a product offering called Elite Macro. You got the call. Talk to me about all the offerings that you have, and then you do conversations, which you do from time to time. So talk about everything. You're a busy guy. Talk about everything you do over there. So
yeah, those conversations, we call them real conversations. We try to make them free, because I think one of, like, with all the blessings that I've had in terms of where I was put, like I said, in the game, God willing, I stay in the game on the right side of the grass here. But I mean, like, I like to educate, or at least try. So those real conversations are free. People can go to hedgeitv.com and see the whole archive of those. But really our product offering follows my process, right? Like, so again, if you want to wake up and get a summary of a pre-market setup across all of macro, you watch the macro show. If you want to watch an entire research team and me running the research team for an hour, that's what the call is. You can basically watch our morning meeting, and that's all essentially taking the top-down views and tying them to stock picks. So for people who only want to pick stocks, that might be what they do, right? And then as we get, like, in terms of like the bigger products like Macro Pro or like the higher price products, it just gives you everything. It's just more of like a full access point. What we find is that people will pick and choose what interests them. Real-time alerts, for example, or intraday market thoughts. Obviously, long short signals. What I call coaching notes. What I see kind of in game. Like, so for example, when I'm done with this, my trades into the close, I mean, I'm going to fade a weak close, because now people are trying to hedge an event that I don't think really needs much hedging until determined otherwise. So, I'll have some buy signals. I'll say, this is why, this is my volatility signal heading into it. So that's very short term. And that's why sometimes people paint me as very short term, which is fine. I'll take any paint, any color, as long as you're paying attention. But the intermediate to long-term views, the Macro Pro subscription, the Elite Pro subscription that you mentioned, thank you for mentioning those. Those get you access to our quarterly and mid-quarter update calls, where we'll drop 100 to 150 slide deck of macro content with all the positions. which include like I'll go around max 30 positions in my long only book in terms of ETFs. And that's another product, Portfolio Solutions, that now I show, like I said at the outset of our conversation, every single day. I show every move that I make in Portfolio Solutions. That would include new positions, removed positions, positions that I add or subtract to.
So we're on the eve of the Fed here. When this comes out, it'll be the morning of the Fed, so this is still pre-Fed. I know you're expecting potentially a little sell on the news because from a dovish versus hawkish perspective, it's hard to get more dovish than, what is it, high 70% chance of 3 cuts, basically cut at each of the next 3 meetings for the rest of the year. So the language is the one thing that people can look at, and the dot plot, whatever that's worth. So are you a little cautious? I know you don't try to time it on a daily basis, but with option expiration happening, a massive option expiration happening on Friday, feels like we might have next week might be the time where something could kind of show its head.
Yeah, anytime. I mean, anytime the NASDAQ goes up for 9 straight days, you should be, in caution mode. I don't care if what the catalyst is. In this case, it's the mother of all catalysts, right? So you have, big time political pressure. We're in the max pressure zone for Powell against what I call pump or Trump. I mean, so you got, pump wants more pump, and Powell most likely is going to say, wow, the inflation data went back up once we get that data, but we don't get that data until after this Fed meeting. So, because we have an inflation nowcast, that's one of the most valuable things we publish that comes out weekly. That's part of the Macro Pro subscription, different subscriptions that you mentioned. So I think that there are multiple, steps to get there. But overbought is as overbought does. It's not a hard concept to understand. Gold's made so many all-time highs, I can't even count them. At least with the NASDAQ, I can count them. But so yes, at some point, bond yields are going to bounce, the dollar is going to bounce, and you're going to get a counter trend, what we call counter trend bounce, and everything that people that missed it eventually chased at the specific point where you should be trimming or booking some gains.
So let's talk about your research offering, because not to get lost in all this macro, you have a great lineup of analysts that bring ideas obviously to the forefront. And I would imagine when they line up when you're talking about, switching from being short Russell to long, when one of your analysts has a small cap name with incredible fundamentals and a buy rating, I would imagine that's when the two kind of marry together. Is that accurate? And talk about some of the kind of the analysts that you've brought on that do have a pretty good following on the street.
Yeah, bingo. Like I said, I'm blessed with my teammates. I mean, I couldn't do this with the accuracy that we do, or the precision in terms of modeling and having views on single stocks, obviously without analysts that know what they're doing and grinding it out every day. So, my favorite product on that is called signal strength stocks, because I basically think about it this way, Danny. I basically take all their tickers, throw them into the machine, and the machine with my machine just basically throws out what are the bullish trends and what are the bearish trends. So if an analyst says, I really like this small mid cap idea, and my signal doesn't, I just throw it out, or I put it on the side and redo it, when I redo the tickers the next day. So it's a very powerful tool. What you find is that the quantamental view is much more powerful in terms of its alpha generation and its accuracy than my former self, which I was just like a stock picker on the buy side. So now we got both. And when you make to your point, a quad shift and you get into small and mid caps, we went from like 50 to almost 100 signal strength long ideas that I would buy that come out of my analyst team. And I think that's a new record. So that in and of itself was a huge signal, because that was like double the shorts in terms of what the machine was actually signaling internally from our own team's research perspective. So yeah, I go through it every morning on the call with these guys. When something is, oversold or overbought, we'll address it. We try to make that actionable. And you probably see that in real-time alerts throughout the day as well.
The Hedgeye machine. All right, before we get out of here, you're not just a pretty face. Talk about Hedgeye Cares, because you guys have done a ton within the community. I know it's a passion of yours. Talk about that a little bit, because I think that gets lost in all the stuff that goes on Wall Street.
Well, thanks. We have our charity golf outing next week. We actually put up, for the first time, we finally came up with the genius idea to make our charity auction online, so people who don't live around us could contribute if they wanted to. But for us, it's like let's give back to our community. I mean, it's hard for me to live in Westport, Connecticut, and not see Bridgeport, Connecticut if I choose to have my Hedgeye's open, right? So, that the Bridgeport Caribe, Youth League, that's a big one for us that we've sponsored and supported for many years now. That's, again, providing, basic things that people like us, take for granted with our kids. I mean, I coach kids in a what is becoming a rich kid sport, hockey, unfortunately. A lot of these kids, like, whether it be their basketball shoes, the cheerleading outfits, stuff like SAT training. If they are a good athlete, they have no resources. Those are the kinds of things that we're super interested in supporting and going directly to it, because we know we can have a direct impact in our own community. So that's big for us, and we appreciate any kind of support anybody wants to have alongside us.
Well, that's great, Keith. And people find you on hedgeye.com, or maybe you tell us exactly where they can find. Is that accurate? They type in Hedgeye and they can find all the product offerings?
Yeah, I have a lot of issues, but finding me shouldn't be that hard.
Exactly. Well, Keith, I really appreciate you coming on the tape. I hope to have you back again. We'll follow all the quads. People out there should follow you. At the very least, if they don't want to pay for product, they certainly can get access to you, like you said, through the videos and then on X and various places. But it's great to have a voice like yours out there that has the experience. And so looking forward to having you back on the tape.
Thanks. Appreciate it, Dan.
All right, NFL Week 3 coming off an 0-2 week, which brings my record to 2-3 on the season. I thought Russell Wilson would stink. He didn't. Giants still lost, but they covered, and shame on me for taking the Jets again. I'm spending way too much time with Vincent Daniel. The season feels like every game is right on the number, and it's come down to the last second type plays. So Eagles look to be the best team, I think, in the NFC. The Rams visit them. They're on the road for a second straight week. It appears they beat a bad Houston team, a bad Titans team. I'm talking about the Rams. So hard to give them credit for that. Eagles look really good and complete. Give me the Eagles -3. Chargers look for real. Last night they beat the Raiders in Las Vegas. They're hosting the Broncos, who I like, but they just seem out of sorts. So Chargers look more complete. I would take them at home. So first home game, by the way, they played in Brazil, and then they obviously played on the road last night in Las Vegas. So give me the Chargers and lay the 2.5. And lastly, I'm going back to the well. I'm taking Dallas, getting 1.5 in Chicago. Chicago defense looks awful. I think the Cowboys will expose them, and I think they're going to use the momentum from their overtime win against the Giants from last week when they go on the road here. So Dallas, the Chargers, and the Eagles are my 3 picks for the week. I'm looking to bounce back. Thanks for listening to the On the Tape podcast with Danny Moses. If you like what you heard, please subscribe on either Apple or Spotify to the weekly podcast, and please leave a rating and review, positive only. You can also watch on the On the Tape channel on YouTube and give us a thumbs up there as well.